I'm Ryan Lightfoot-Brown, Research Analyst at Chelsea Financial Services. We're joined today by Ben Edwards, Manager of the BlackRock Corporate Bond Fund. Now, while an equity manager may only buy one share of a company, bond managers have got the luxury of having multiple different lines, hundreds of thousands of bonds on offer. How do you go about finding the best opportunities?
Yeah, look, it's a really good point. It's something we've talked to clients about for a long time. Probably the best example is banks, because not only do they have bonds that are of multiple maturities, they have bonds that have multiple currencies, but they also have bonds that have multiple subordination, ranging from a AAA rated covered bond backed by prime mortgages all the way down to junior subordinated debt, maybe closer to equity in terms of its absolute risk. They may also be issued out of different operating companies, subsidiaries within the bank. All of those bonds are going to have different interests to pay to clients to compensate them for the different risks that they're taking on. We've given an example to clients recently where over a 2-year period, the worst Barclays bond in sterling you could have owned lost you about 3%, and the best one made you about 15%. So a huge difference there, and actually what it means is it can make more of a difference which bond you buy than which company you lend to, certainly over the short term. Ultimately, credit markets are incredibly inefficient. And so in terms of finding value, which of those bonds might perform better than the market, sometimes it's easy as just looking at all the bonds in the secondary market and identifying which or which few of them are most far away from their fundamental value. It may be for technical reasons. For instance, we saw US fund managers wanting to rid themselves of UK bank risk before the Scottish referendum, then again before the Brexit referendum. We're starting to see that come back into the market now, and they just don't want to be caught with risk that potentially they don't understand. That's an opportunity for us if we can be a little bit more long term. It may be from a regulatory point of view. So some bank bonds are issued prior to the new regulatory regime, some of them prior to the financial crisis. Because those bonds don't serve a good purpose anymore from a regulatory point of view, there's a huge incentive for banks not just to call them on their first date, but actually go into the secondary market and buy them back. And for that reason, you might get a return that's better than the average.
I've talked a lot about corporates, and your fund being a corporate bond fund doesn't have a lot, but you can also have government bonds, and 3 of your biggest holdings are UK government bonds. Is this a tactical decision, or are you just being a bit cautious on outlook at the moment?
So the simple answer is yes. We've been cautious for most of the year. We've had a fairly clear view that some combination of increasing US rates, a stronger US dollar, and global quantitative easing programs that are either about to come to an end, or in fact in some cases being unwound, which is the case with the US, would cause global financial conditions to tighten, and that would be a headwind ultimately for the global economy and for risk assets, whether or not that's credit spreads or whether or not it's equities. And that's broadly exactly what we've seen. And the second reason is because we tend not to in the fund lend to the very best quality issuers, those AAA and AA rated borrowers. They're very, very safe financially, but because they're very safe, they don't pay very much, and our investors can't make very much from lending to them above and beyond governments. So it means that we tend to hold a reasonable amount of liquidity in the portfolio via cash and gilts. That flexibility gives us a chance to engage with markets when opportunities arise. It means that, for instance, over the last 3 or 4 weeks, as value has been coming back into credit markets, we haven't had to go out and incur costs to sell corporate bonds to buy other more attractive corporate bonds. We can interact with value where we see it, whether or not it's in the secondary market, or in fact whether or not it comes via new primary markets.
And also in your top 10, you've got a Tesco property bond. How does this differ from some of the other Tesco bonds that there are available?
Yeah, so Tesco's been a long-standing position, the Tesco property bond that you mentioned, for many years now. Actually, all bonds and Tesco are no different. Effectively are serviced both interest and principal by the operating cash flows of the business. The Tesco property bonds differ a little in that effectively you're being paid back both principal and interest via long contracted lease payments from Tesco to the structure, effectively rent for Tesco Extras, superstores, and in the case of the one we own, a large distribution centre on the M1. What that means in practice is that in all normal scenarios, they're identical in terms of credit risk. We rely on Tesco doing exactly what they've said they're going to, but what it can also mean is that in a worst case scenario, and one that we don't expect, were Tesco to not be able to pay back their debts, were they to move into bankruptcy, we'd have that additional security of those properties to sell and increase the recovery value that we're likely to get. The other nice thing about those bonds is that much like all of our mortgages, it's not just an interest payment and then a bullet at maturity. We actually get a little bit of the principal back every quarter with the interest payments, what that means is not just is the security staying reasonably static, or in fact going up with inflation and the valuation of the property market, but the debt is coming down. So the security itself is becoming better value over time. That Tesco property bond that's been in there for a number of years, even over the period where we all know Tesco had some operational and some accounting issues, which saw those bonds downgraded from investment grade to high yield. Those bonds have generated about 6% per annum over the last 5 years, including that period. And actually that 6% beats both the sterling investment grade and the sterling high yield market. So it's been a pretty good investment for us.
With the US raising interest rates and the UK potentially and starting to do the same, where are you finding the best opportunities at the moment?
So I'd make the point that yes, US rates have been increasing, but the rest of the developed world's policy rates haven't. It's been long our view that the Bank of England, the Bank of Japan, the ECB are unlikely to get far away from where they are before the economic and monetary cycle turns, and we actually start talking more about cutting rates than increasing them. In fact, the last few weeks we've been talking about how far we think the Fed can actually get before they're going to need to pause in their current cycle. As far as the Bank of England specifically, I appreciate that were we to move through the parliamentary vote with relative ease, I don't think that that's a given. Were we to move to transition, the Bank of England would very much like to hike rates in the first part of next year. But I think at that point we then end up with something that we haven't had for a long time, which is a data-dependent central bank in the UK. And in my view, the UK economy, even in transition, but without understanding what future trade will look like, what the end state will be, is unlikely to warrant large increases in bank rate from where we are, and in fact probably can't withstand much higher rates given the amount of debt that's been accumulated since the prior crisis. So what that does in terms of opportunities is thrown up an interesting quirk, if you like, as the US is hiking without the rest of the developed world. Currency hedging costs have blown out to a level that none of us have seen in our careers before. The cost for us to access the US market on a hedge basis is about 2%. But interestingly, the access to the European market on a hedge basis comes the other way. We get an additional 1.5% yield per annum on anything we buy. And so if I look back at 2017, where we really couldn't get excited about European currency bonds, Mario Draghi had bought them all. They had suppressed yields to a point where they were completely unattractive. Now, if I look at European fixed income, with spreads having widened for the best part of a year, with that currency hedging effect moving from about 1% to 1.5% in our favour, we're now looking at things like European corporate hybrids, investment grade, that may pay 4% in Europe, but pay 5.5% in sterling. We're starting to look at a European high yield that is looking like above 6% hedged back into sterling. Those sorts of valuations over the medium term look good in anything other than a crisis. So we're starting to look at those as opportunities for next year.
Ben, that's really interesting. Thank you very much for coming in. For more information on the BlackRock Corporate Bond Fund, please visit chelseafs.co.uk.